have a little legal disclaimer here. General information, please read that at your leisure. And today we've got myself and Jim Brandenburg. Welcome, Jim, and glad to join you again today.
Thank you.
Okay, so with that, this is the agenda for today. We'll look a little bit ahead in terms of the outlook, not only in terms of maybe end of the year outlook, but some changes that are going to happen over the course of the next 2 or 3 years with some of the expiring provisions from the Tax Cuts and Jobs Act. Kind of look back at some 2022 legislation, and now the rules are rolling out. We're going to hit a few slides on employee retention credit, right? Some recent developments. We'll also talk about what the IRS is doing, so a few court cases, and finally something new, and we'll give you a little more information on that when we get to that, but we'll have what we call a lightning round. So with that, I'm going to turn it over to my friend Jim Brandenburg, and he will take us through the first set of slides here on the tax legislation outlook. Jim?
Thank you, Tom, and good morning or good afternoon, everyone. Thank you again for joining us. What we're going to be looking at here is some possible tax legislation here for 2023, and again, is usually the course. Usually get this toward the end of the year. Nothing really has gone through so far in 2023, but it seems that it always falls into the end of the year legislation. A couple things, as Tom mentioned, is from the Tax Cuts and Jobs Act, which was actually almost 6 years ago now, a couple items that actually have an impact here in 2022 and 23, and actually in 2026 we'll go through, is just to keep a reminder of some of these items. Some of those we're already dealing with, and some we may deal with soon. Versus these R&D expenses, we'll cover that in a little bit more here. That again, that's used to be currently deductible. Now we have an amortization of those. The interest expense deduction, there's a change with the ATI calculation that we don't add back depreciation and amortization. We'll discuss that. Then bonus depreciation that many are familiar with. Again, it scales back. It had been at 100% for a number of years, going to go back to 80% in 23 for additions, and then 60% next year. Next slide. And then in 2026, again, these are not that far. At first we thought we'd never get there, but it's not too far down the road here. The individual tax rates are going to go back to the 2017 rates. They'll be higher. Corporate rates at 21% now are not scheduled to change, so that was not part of any change. Those are going to stay at 21%, I guess, unless Congress were to decide to change it, but there's no scheduled change for those. A couple other items here just to note: the AMT exemption, which a lot of individuals were subject to a number of years ago. They raised that exemption. That's going to go back to the 2017 levels. So we may see more folks in AMT in a few years here. The SALT deduction, which we'll talk about too, that cap of 10,000 goes away. The 20% QBI deduction, which again, a lot of pass-through businesses have taken advantage of, that is eliminated. And then the higher estate and gift amounts that we got, starting in 2018, that those were doubled, those are going to go back to the 2017 levels. So again, these are a number of items here that Congress is going to have to deal with, whether they extend, they let these expire, or somewhere in between. So some significant items that we have on the horizon, not too long, that they're going to have to deal with all these items. Again, I mentioned again on the research expenditures, something to be aware of with it. Again, the Tax Cuts and Jobs Act put this in. Again, used to currently any R&D expense, again, separate from the tax credit, you're able to deduct those currently. Starting in 2022, however, what Congress changed was to put a 5-year amortization of those R&D expenses. Again, this is for the expense, not the credit, but they give a half-year convention. So you only got 10% in the first year, then 90% of these is deferred and amortized over 5 years. If it's research that's outside the U.S., there's a 15-year amortization with it. Again, Congress had always supported R&D efforts, but again, they didn't think this was actually going to take effect. They thought that they'd be able to get some extension of this, but that did not happen. They tried at the end of 22 to get that done. It didn't work. Again, there's efforts now to do this and to go back and allow the current expensing, but that has not happened yet. Again, a couple of things with this R&D expense. Again, it's a responsibility of the taxpayer, the business here, if you're a business with it, to gather those costs. Some of the costs that fall under this 174 for R&D, you know, labor, the labor used in research activities, some of the lab costs, rent, even internal use software could fall within there. So you've got to go through and capture those costs. And again, you don't get a current deduction. You've got to capitalize those and amortize those now. One thing to note, the next slide here with it is just a couple weeks ago, this notice 2023-63 came out, issued on September 8th. Again, that's in your chat. You've got a full copy of this. This is effective for tax years ending after September 8, 2023. So again, it's not for your 2022 tax return that you just filed or will be filing here in the next couple weeks if you're a C Corp. This will be an item that you're probably going to deal with for 2023. And what the IRS did here is more of an expansive view of how you're going to have to determine those costs. So again, you may have more costs in 2023 than you did for 2022. So just be aware of what's in this notice and what you're going to have to include. And the IRS mentioned there's, even though this is a change of accounting, there's no Form 3115 that you're going to need to file with it. And one thing also to note is the state treatment for this R&D costs can vary from state. Some states might allow you to continue to currently deduct those, others follow the federal. So something to be aware of for your state. Next thing with it, back to the interest expense limit, again, that came around. One of the things that, again, changes for 2022 is when you do this adjusted taxable income, determine how much you can deduct. One of the things that you had added back the last several years is your depreciation and amortization. That does not apply in 2022, so that threshold is going to be lower and it's going to be harder to deduct your interest. And then you couple that with the second item here is our current market condition. Interest rates have continued to rise over the last year or several years, so you're going to have more interest expense. So you have more interest expense with a lower threshold to be able to deduct that. So you're going to probably see a lot more businesses subject to this interest expense limitation here. And again, if you are subject to that, any disallowed interest will carry over that you may be able to use in the future then. Then our last item here is the bonus depreciation. Again, that's been 100% for a number of years. What happened is starting in 23 here, that's going to drop down to 80%. And then next year to 60%. So again, if you have a major addition or fixed asset addition that you have that's eligible for bonus, you might want to make sure you get that in before the end of the calendar year so that you can get that 80% limit again, unless Congress were to make a change with that. So what are we looking at? Next slide here, possible tax legislation. Again, Congress is aware of these business items. The House Ways and Means in June went through and again focused on some business items. The 174, the research expense was put in there. And what they would do is go back and allow that to be currently deductible, even back to include 2022. And one of the changes they would make is, let's say this did get enacted, that they would allow you, so you don't have to amend a return, allow what you didn't take for 2022. So the 90% you didn't take in 2022, you could take, let's say in 2023, plus deduct your current items in 23. So that would be, you know, a way to make it, to get your deduction and not have to amend a return. But again, that just went through the Ways and Means. It's still got to go through the rest of Congress to be enacted with it. Again, this bill also included a change on the interest expense as well as bonus depreciation. So one thing, again, the next slide is what they're looking at is, again, even though there's some bipartisan support for these changes, there's a number of members of Congress, Democratic legislators that are in support of the R&D and some of the other ones, but what they want to do is also expand the child tax credit and say if we're going to do those R&D and interest and bonus depreciation, they want the child tax credit also expanded. And if they can come to an agreement as to do those business provisions as well as the child credit, they'll have some compromise with which to move forward this fall. But even if they get a compromise, they need to have some bill to attach that to get it passed through Congress. And there's a couple possibilities. There's an FAA bill, there's a farm bill, a defense bill, or maybe some spending bill that they'll look to say, these are really important. Maybe we can attach these tax provisions to it. So that's something we'll keep an eye on with it. Beside these business items that we mentioned, 1099K for you know, the $600 reporting could be included in there. They could change the $10,000 salt limit could be part of the bill. 9 itemizer for charitable contributions, enhanced HSA contributions. In fact, the Ways and Means Committee is talking about HSAs, in fact, today, that they may be expanded. So that might be something that ends up in an end of the year bill, and also the low income housing credit. So all these things are kind of in the mix here. It looks like nothing is going on, but somehow it seems when you get to the end of the year, some of this falls together. I still think there's a possibility we get some R&D or other business legislation this year. Before the end of the year is probably a 50-50 chance at this point. So that's a little legislative outlook here for 2023.
Jim, don't you think with the election coming next year, I mean, if any tax changes are going to happen, they're probably going to happen before year end. It's unlikely they do anything next year, right?
Yeah, I would think it makes it harder to do it next year in an election year. I think you're right that they'd like to get it done before this year and not have to deal with that and have that hangover to next year. But again, we'll see what happens here when you get probably in November, December with it.
Okay. We're going to cover, I'm going to hit some of the energy credits and Jim is going to talk here about some of the Secure Act changes and Secure 2.0, Secure 1.0 and 2.0. And of course, there's been a lot of guidance and regulation come out. So we're going to try to cover some of the things that we think will impact a lot of you in the audience today. But I want to touch on some of the energy credits that affect both individual taxpayers as well as businesses, and what that might mean for you. So we have a list of them here. By no means this is a complete list of all the energy provisions in the Inflation Reduction Act. It's not. Some of these are credits. Some of these, and I didn't list any of them, we're not going to talk about them today. Some of them are actually, you have to apply for a grant to get some of the stimulus or the credit money. So there's a lot going on there, and you know, I think there's new guidance coming out pretty regularly on this as they try to implement some of these laws that Congress passed. 179D is not a new deduction. So this is not a credit, this is a deduction, okay? So it's an accelerated deduction for energy efficient commercial buildings. This has been around a while, but they changed the provisions pretty significantly in terms of the amounts and what can qualify. So the energy usage, in other words, the efficiency gain, they lowered that threshold to be greater than or equal to 25% reduction in energy costs or energy usage through you know, putting in more energy efficient systems. So you can qualify now versus I think it was 50% before. It had to be a more than 50% reduction. So the immediate deduction of 50 cents to $1 per square foot depends on efficiency gains. And you'll note this a lot, but some of these provisions, the amount of the credit, or in this case deduction, depends on whether prevailing wages are used for the installers and the folks that are the professionals and engineers that are out there putting in these systems. And then there's also these apprenticeship requirements as well. So both of those have to be met. Generally, it's a 5 times multiple. So if you use prevailing wage and they meet the apprenticeship requirements, you're probably going to get 5 times the benefit, okay? In this case, this deduction, the owner of the building is eligible for the accelerated deduction. So you do need a certification in this case to get the 179D. A little more on 179D, and this is really kind of where there's some changes in the amount, but there's some new opportunities here. If it was a government building in the past, because the government isn't a taxpayer, they could assign that deduction to the designer or design team. So they've expanded that now, and that deduction, that assignment of that deduction can now be for you know, other buildings built for Indian tribes, actually nonprofits, churches, and nonprofit schools also qualify. In other words, if you implement energy efficient type systems that qualify under 179D as a contractor, maybe an architect or design engineer, you might be able to get this deduction assigned now. And it's not, like I said, not just on federal, state, or local government buildings. The other thing that changed is retrofits of existing buildings. You don't have to have a new building now. This new law allowed the 179D to be for retrofits, right? And so it has to be at least 5 years old of a building, and you can get 179D technically every 3 years. So you can do some energy efficiency improvements now and get the accelerated deduction. 3 years from now, you can do some more. So some different new provisions there to try to incentivize folks to implement energy efficiency changes. 25C is a individual credit, right? Energy efficient home improvement credit. This is for your primary residence, okay? Improvements, energy property expenses, and home energy audits are qualifying costs. So basically windows, doors, and actually $150 of a credit for a home energy audit. What will home energy audit cost you? I don't know. I've seen numbers, but I think it's somewhere probably between $500 and $1,000. So they're really giving you a credit for the sort of the tax effect of that. Heat pumps, $2,000 annually, or biomass stoves or biomass boilers. What changed here is the amounts. Used to be a lifetime amount. Now it's an annual amount. So you could get up to $3,200 a year of credit for energy efficiency home improvements. Okay, 25C. And now we have another code. So I'll give you a minute to take, if you want to scan that QR code or enter in 554 into that conference IO. So, okay. All right. So section 25D, residential clean energy property credit. Okay, there's no limit on this. It's 30% of the expenditures, 30% of the expenditures. So now this one can be used on a primary resident or a second home. And actually, if you rent a home, right, you're a tenant, you could actually make these improvements and qualify, even if you don't own it, right? Qualify for this credit, right? Solar, water, solar, electric, wind energy, geothermal. And what's new in a lot of these different credits is battery storage or battery connectivity now is in a additional qualifying cost. So that's the same case here. So that's 25D, again, residential, so really more for an individual taxpayer. Clean vehicle credit, we've heard a lot about this. $7,500, and there's some AGI limitations there. So married filing jointly, $300,000. So to qualify for the credit, you've got to be under those thresholds. Starting in 2024, you could actually use this credit as a down payment on your car, right? At the point of sale at the dealership. There's an article just yesterday about how quickly is the government going to pay the dealership that $7,500? So, that starts next year. It's been published, the MSRP of vehicle cannot be over $80,000 for vans and SUVs and trucks, and $55,000 for automobiles. So that's the new clean vehicle credit. 45L is for home builders. Okay, this also is not new. This has been around a while. And it's really for your HVAC system. So what's changed about is the amount. So now you can get up to $5,000 per unit for multifamily, but that's a big range there, 500 to 5,000. It depends on energy efficiency standards you meet. And then also use of prevailing wage labor. So if you use prevailing wage labor, you're going to get a lot higher, per unit credit. For home builders, right, single family home builders, the credit's $2,500 or $5,000, depending on these two these energy efficiency certifications. Zero energy being the better one or more efficient per single family home. Okay. So the only difference here between those amounts is which of those, whether it's Energy Star or Zero Energy, you qualify for. Nothing to do with prevailing wage or apprenticeship on single family homes. Okay, 45L. Okay, so and then you got the commercial clean vehicle credit. And this is for businesses, and you can kind of see the limitations there. For vehicles over 14,000 pounds, you get up to a pretty sizable credit there for buying a qualifying vehicle. So form on this is not yet available. Okay. So and 45X is really more for producers. All right. So a lot of these we would probably call investment credits, where we invest in energy efficient type property. This one's more about producing energy efficient property, right? Whether it's components, whether it's miners of certain raw materials. That's also out there for those producers or manufacturers, right? 45X. And then the renewable energy investment tax credit, again, a business credit. And this one too, you can see there, the credit ranges from 6 to 30%. Battery connection is now a part of this. So the qualified energy property is kind of your standard list: wind, solar, battery, and microgrid. So a lot of credits out there. Secondly, nonprofits can qualify for this. So if they invest in some renewable energy, solar panels or something like that, they too could actually get this, and it is refundable. So businesses, you have to use it to offset ordinary income, and a lot of these credits are transferable, right? That you can sell them. So this one as well. So now in this case, you gotta, if you sell the credit, the buyer is going to want to make sure that it doesn't get clawed back. So there might be a little more due diligence involved in making sure that it qualifies for the credit. Lastly, there's domestic content bonus credit. The vehicles, there's some of this built into that. But if the materials used for those energy efficient type of systems are domestic, you get a 10% bonus credit, right? So a lot going on there, a lot of new regulations and guidance coming out. That law is not that old. But we've seen a lot of new guidance come out. So we're really starting to hear more about this and starting to see different businesses and frankly, nonprofits start to look at these credits and how they might fit for them. So, Jim, I'm going to let you talk about Secure 2.0.
Good. Thank you, Tom, and thank you for the overview of all those energy credits. Very helpful to be aware of some of those. And again, we'll keep an eye on some of the guidance as that comes out. One of the other items that was actually enacted back in 2022, along with that Inflation Reduction Act and some of those energy provisions that Tom covered, was right at the end of the year, and it was a omnibus spending bill, the Consolidated Appropriations Act that was enacted right at the end of the year. But part of that was the Secure 2.0's retirement legislation that was included within there. Again, is referred to as Secure 2.0, which again follows up on Secure 1.0, which had some other retirement provisions that was back in 2019. Again, there's a lot of bipartisan support that they had with this Secure 2.0, and it was included in there. One of the things I put on here at the bottom, and I'll try to highlight when I go through some of the selected items in here, is the effective dates on some of these Secure 2.0 provisions. They're kind of all over the board. Some are effective right away when the bill passed. Some are effective here in 23 or 24. Some are a few years down the road. So, and some of those changed slightly. The House and Senate had very similar bills for the Secure, but when they finalized it, they changed the dates. Each one, they had to be the exact same. So they made a few changes with it. So be very careful when you're looking at the provision to see exactly what the effective date is. The first one we've got here is what they call the RMD, required minimum distribution that individuals have to take. Again, they used to be 70.5 for years. The Secure 1.0 pushed it up to 72. Now 2.0 changed it, and starting in 2023 here, it goes to 73. And then look here again, 2033, it's going to go up to 75. Okay, so again, beware of those higher RMD dates as to when you have to start the distribution. The next one to look at is catch-up contributions. That's been around before, was when you got to age 50. Now they've got even some higher catch-up when you get to age 60, 61, 62, and 63 that you can get some additional amounts for. We've got the limits there, what you can apply for. Again, the amounts will be indexed for inflation, but that inflation doesn't start until after 2025. These are effective for tax years, again, after 24. So again, different effective date with it. But again, for those in that age category, they can put even a little bit more. And again, they want you as you get closer to retirement to put as much as you can into these retirement accounts. Next is, again, we talked about the required minimum distribution at the age 73 now. The other side is if you don't take those required minimums, there is a penalty tax on it. The penalty used to be 50% of what that required minimum was, with very severe penalty that you had to take. The Secured 2.0 would reduce that to 25%, and then it's even down to 10% if you take the corrected amount within the second tax year after what you should have taken out. So again, that's a favorable change. Again, that's effective, starting here in 2023. So, and it kind of matches up that 10% for not taking your required minimum, sort of along the same lines as the 10% if you take a distribution before 59.5 on the front end of your retirement account. So that's, again, another favorable change. Next is, again, what they do have is a new provision here that allows you to put up to $50,000 in what they call a separate split interest entity, which could be a charitable remainder trust that you could transfer money out of your IRA into those accounts. The other thing, and that starts in 2023, there hasn't been any guidance yet that I've seen on that. The other thing is there's a $100,000 that you could take out from your required minimum that could go to a charity, directly to the charity. You don't pick it up at income, you don't get a charitable deduction, but that's been around for several years. That's going to be indexed for inflation. So look for that amount to be higher here in 2023. I don't know if they've set the limit on that yet, but that will be indexed for inflation. Again, a number of taxpayers take advantage of that. Next one, the elective deferrals that you can get with the catch-up contribution. You could do those on what they call a pre-tax basis or on a Roth basis, so you didn't get a deduction for it if the plan permitted for that. What they were going to do is change this. So actually, it was supposed to start in 2024 for those over $145,000 of income. They couldn't do those on a pre-tax basis. It had to be on a Roth basis with it. Again, that was actually one of the larger revenue provisions within the Secured 2.0. So be aware that one thing that's interesting with it is the IRS just announced here late this summer that the effective date on that's going to be pushed off to 2026. So if you're in that group that you're doing these catch-up amounts, that you can do those on a pre-tax basis, again, not only for 24 and 25 before the new effective date would start here. So again, that's just something to keep an eye on. Next, another thing that the IRS did is, they have a provision where, again, with Secure 1.0 talked about there's a 10-year payout for individuals, for non-spouses with a, with an IRA with it, how that was going to work. And they put a notice saying, well, we're still finalizing the rules. They put that out, notice 2023-53. Now they put another one out this year, 2023-54. We're going to say, we're still trying to formulate these rules. We're trying to sync up Secure 1.0 and 2.0. We're trying to figure out these rules for distribution. So they said those new rules will apply no sooner than the 2024 year. So keep an eye on that if you're looking for payouts from an IRA with it. And then another part of that, the next slide with it is, if you were going to take out a distribution this year and you thought you had to take it out, and that you were 72, well, now the age required minimum, again, as we've talked about, goes to 73. We took a distribution out, maybe you didn't need to take it. The IRS indicated in this notice, 2023-54, that if you took that out already this year, you got a amount from January 1st up through July 31st, you have until actually the end of this week, September 30th, you can roll it over and put it back into your IRA and not pick that up into income. So something to be aware of. So take a look at that notice 2023-54.
Okay, thanks, Jim. Good overview there. A lot to the Secure 2.0. We tried to cover items that we thought were in most immediate and most relevant to the group today.
Right.
So
there's a lot more. You're right, Tom. That those were just some selected topics. There's a number of other ones in there. So
yeah. So keep your eye out. Talk to your financial advisor. There's probably more guidance coming out, and we'll cover it in future webinars, I'm sure. So employee retention credit, we've seen a lot happen here in probably the last year or so in terms of just the IRS starting to gear up for enforcement. But Jim's going to cover really most recently what's happening. But as we probably know, you for a while there, you couldn't turn the TV or the radio on without hearing somebody talk about how there's $26,000 per employee available to you. And when you probably some business owners got on the phone with these folks, they found out there's a contingent fee involved and all those kinds of things. A lot of these firms, the IRS started using a term called ERC mill. They were newly formed and they were opportunistic to take advantage of this. And frankly, the IRS started to figure out, as many of the professionals did, many in the CPA world, that they were being pretty aggressive on their interpretation of the rules. I saw a number recently that they believe claims filed this year, about 95% of them are in error. So they really, the number of claims this year has gone up a lot in terms of the weekly intake, and they believe the error rate's also a lot higher. So, the question is for us, for our clients, for you as a business owner, if you use one of these third-party ERC providers, will they be around if you get audited? Do they have the documentation to support the credit? Are their arguments going to stick? These are all real relevant questions, can you potentially get your feedback? Depends on the letter that you engagement letter you signed and the terms of that contract. So all these things are important to find out. And for those on the call maybe today that are still considering ERC, I mean, this might be a good sort of short checklist as you're talking to someone about potentially helping you with that credit. It might be something to look at. We also have another checklist. Of course, the IRS has released a checklist. So, recently the IRS has started to really push back, put out their own, media releases about this to, basically be careful, right? Be careful. It is a legitimate credit. There's obviously a law out there that supports it. But there are a lot of aggressive, you could see there some of the things that the IRS Commissioner Doug O'Donnell, when he was commissioner, acting commissioner, said. And then when the IRS released the Dirty Dozen list of tax scams, the ERC was the top of that list. It was the first one that they released. So they're very focused on it right now. And I'm going to let Jim talk about just some of the more recent developments here. But let me cover just the last slide here. PEO. So one of the things we saw early on in terms of audits is the IRS started to audit PEO. So if you use a PEO, you probably know that they might have 100, 300, 500, 1,000 different employers that they report for, and those all the payroll tax reporting is really on probably one quarterly return. So the IRS likely looked at that as a good place to start. They kind of are holding the PEOs a little bit accountable, which was caught some of us by surprise. But so the PEOs probably are the first place that they really started to audit, and those processes are still going on. And so we do know from our clients that used a PEO those claims are slow in being processed, and PEOs have taken more safeguards since all this came about. So just know that that is a focus of the IRS. Jim?
Yeah, and it's important with these, as you mentioned, Tom, with those PEOs to realize that, again, they're going to look to the whole PEO for those claims. So it's, you're going to be, if you're using one of those, you're going to be combined in with all the other companies that they deal with there. And if you're a PEO yourself, realize that you're on the hook if for somebody who filed an ERC and they work through you, you're going to be responsible for that. So there's just a lot of make sure that, as you said, your engagement letter addresses some of those issues. It's important with it. Right. And that came out earlier this year, I believe, Tom. It was, I think, during March or April or so that they came out with that. And that was kind of a surprise because we hadn't heard about that. Tom mentioned here in this ERC, it's important that the IRS is really starting to crack down not only with some of their marketing efforts that they mentioned, some of the audits that they're doing, and even some criminal investigations, but they came down, really two things. One is in July here, late July, they issued what they call this Generic Legal Advice Memorandum, or a GLAM, that came out in July. And it dealt with the what they call the supply chain disruption. A number of companies were trying to say that they qualified for the employee retention credit for a government order, and that was because of a supply chain disruption. It was a government order due to COVID, and we qualify for the ERC because of that. And we saw quite a few of those from a number of these third-party providers, or had sent them to folks that were looking at possibly getting this credit. And what this IRS memo said is that no, that supply chain disruption does not allow you to have a qualified government order and be eligible for the ERC. And they provided in this what they call this GLAM, and it's actually in your materials there, the chat, that you can look at this. They had 5 scenarios in there that they went through, and in 4 of them they said no, you weren't eligible for the ERC. In one of them they said they would be, but in that case the actual company and a supplier were both actually shut down by the direct order for a month, and they said no, you qualified for that 1 month but not any period after that. So once the order was lifted, there was no supply chain disruption available for them. So very limited application that you could get the supply chain relief with it. In most of the other cases, and again, what a lot of these third parties or providers are trying to use, the IRS really, eliminated that opportunity if they really read through this GLAM advice that the IRS issued. Next thing, and this just came out within the last 2 weeks, is it really came down. This is where they really put the hammer down, was on September 14th, 2 weeks ago, last Friday. And what they said was, with all this even marketing campaign that they had, they finally said, we're going to just hit the pause button, as the IRS said, is to say any new claims, we're not going to process those. We're going to at least wait until after the first of the year before we even look at those. So what we're doing is, not allowing any, processing of new claims with it. We just want to have a moratorium so we can, catch our breath, if you will, with all these claims that have, really swamping the IRS. What the commissioner said, Werfel said, was there are some legitimate claims out there that are coming in, but they're getting drowned out by all these other, frivolous or even fraudulent claims that the IRS has to deal with. So we're going to put a pause on processing these new ones here and try to go through the backlog that we have. So what they did, was to, again, put that moratorium in. And then next slide here, Tom. What we're looking at is, what's a company to do now? And it really depends on where you're in the process. The first thing is, if you've already filed your claim, but it hasn't been processed and paid yet, first thing to note is the IRS mentioned is they're going to have more review procedures. So if yours is in the queue now to get reviewed, they're going to take a longer time. They said it could take up to 180 days or more for them to finish their processing of that claim. They may request some documentation from you. It's just going to take a longer review to get that processed. The other thing they want you to do, though, is while it's in this longer process, is maybe you go back in and look and say, maybe we did have the third-party provider put us through, and maybe we're not eligible for it. they're going to give an option. They haven't released the details of that yet. For you to be able to go through and withdraw your claim, saying, well, maybe we don't apply for it. Let's go through this withdrawal option, withdraw our claim. We're not going to get the refund, but maybe we won't have to pay our third-party provider the contingent fee that Tom mentioned before. You won't have to pay them that. So that may be one thing that companies that are waiting for a refund consider if they don't think that they're eligible for it. The next thing that they have with it is, let's say you filed for an ERC a while ago, you already got your money, you're done with that, but you say, we looked at it and yeah, we did have a third-party provider. We paid a fee, but maybe we took the supply chain and really shouldn't have, and we're not really eligible for this credit. What can we do? The IRS said that they're going to provide a program that you can actually repay that, perhaps avoid a penalty with it. Not sure what you're going to have to do with that contingent fee. Again, it wasn't because of an audit. You're voluntarily repaying that, but perhaps there's something that you could work out with that third-party provider to get your fee back that you paid on that. So that's something that, again, the IRS can provide guidance in. And the last thing is, let's say you're one that hasn't filed it, but maybe you think that you qualify for it. They will still accept an application. They're just not going to start processing it until next year. But again, review what's out there just to make sure that you're eligible for it. They want people to really make sure that they're eligible for it. Talk to what they refer to as a trusted tax professional, not one of these third-party providers with the vested interest, to see if you are eligible for that, and then file. And then again, you're going to have to wait a bit for your refund claim. Two things also to note with this is in the same notice here, and again, we provided some of that in the materials here. The IRS has a new ERC checklist, kind of help businesses go through to help them determine whether or not they may qualify for it. So that may be helpful for you. And again, as I mentioned before, what the IRS really wants you to do is, if you're looking at the claim, either for a claim that you're going to file or one that you've already filed, but maybe you didn't use a trusted tax professional to go to them, go through and really look at your situation to think objectively whether or not that you may qualify. And again, you may turn to your CPA or other tax attorney or trusted advisor to help you in that process. Again, a lot going on with the ERC, and again, we'll continue to see things, I think, over the balance of the year and into next year with this.
Okay, thanks, Jim. We're going to jump over to the next section here and talk about just kind of some things we're seeing and court cases that we've of note that we think are relevant to the group here. So first thing is, you may have read this, but sorry, I think I skipped a slide maybe. Okay, maybe I didn't. Yeah, so promoter-sponsored transactions. The Dirty Dozen came out earlier this year. I mentioned that earlier. And one of the things they really focused on is promoters or sponsors is a word they use, where it's someone who comes up with a tax-saving strategy, and they really try to go out there and promote it. And, some of the ERC mills fall into this category. So, they're really starting to focus on them. You might have seen some stories about what's called a conservation easement, where there's really some aggressive promoters of conservation easements. So just be careful and know that, if somebody comes to you with a strategy, you got to first identify whether or not they're a promoter. There's kind of a definition out there. And secondly, it's probably something they need to disclose, right? So second thing is IRS initiatives. We've probably seen, if you read the Wall Street Journal or follow some of the business news channels, the IRS has announced that the 75 largest partnership returns being audited, right? And so these are big returns, more than 10 billion in assets. They did use AI to help select those companies for audit. So they're really starting to dig into large partnerships, large corporations. Last week, they just posted the job. They've got 3,700 auditors they're trying to hire specific to this initiative, right? So they're really starting to focus on high wealth, bigger partnerships. They really think, based on their information, they believe there's some opportunity that there's some underpaid tax in some of those. Whether or not that proves out or not, we'll see. but that is an initiative that's underway, and I expect to see the level of audits increase for those taxpayers. I want to point out a case here. One of the things and I think all professional firms are really focused on is more disclosure, and specifically around international tax matters, whether you have assets overseas or even in Canada or Mexico, or you have business, you're transacting business, selling product overseas. There's a lot of new disclosures we got to deal with, and of course we know about the FBAR is a common one, where you might have a bank account out of the country, and if it exceeds $10,000, so failure to disclose those things can be, you can have some significant penalties, whether it's at an entity level or an individual level. So this particular court case is one where the Supreme Court, or I'm sorry, the tax court actually found that the penalties were not constitutional, right? They didn't have the authority to assess those penalties. The Supreme Court is going to hear this case. For those taxpayers that may have paid some of those penalties in the past, you might consider filing a protective claim, right? Because if the Supreme Court rules consistently with the lower court, then you may be eligible to get some of those back. Bittner was another case where, again, FBARs weren't filed. The IRS, pardon me, said it's $10,000 per account, not $10,000 per year. The Supreme Court disagreed. It was a very close decision. The key here was the IRS determined it was non-willful intent versus willful. There's a legal definition out there that you got to understand what that means, but willful violations, they do plan to assess that $10,000 on a per account basis. But Bittner was able to get by because it was non-willful. Hohenscheid is an interesting case. There's a couple things here. As we do more and more planning with clients as they transition their business, as they think about gifts of stock, maybe closely held stock, these are important. This is an important case to look at, right? And the key to donating stock ahead of actually selling the company is timing. And the timing of it, if you expect to donate the stock and get a deduction for the fair market value of that stock, you really have to do it when in a time frame where the sale is not imminent, right? So there's this concept called assignment of income doctrine, and this really comes into play with just a charitable gift as well, right? So a charitable gift, or even a gift to this in this case, this was a charitable gift, but a gift to a family member per se. The other thing that happened here, really good case to look at, is the court really came down hard on them. They didn't even get a charitable deduction, right? So they paid tax on the gain because they said, well, you didn't donate it soon enough, so you didn't really accomplish that tax strategy. And secondly, you don't get a charitable deduction. Why? Because the appraiser was employed by the financial advisor. They weren't a qualified appraiser. The valuation report had several deficiencies the IRS determined, and the date of the report was well before other significant financial events happened, and so it was in the IRS's eyes overvalued. So if you're going to make a gift, I think you got to be careful. You got to know these rules. Get with your advisor, understand these rules. Hohenscheid case is a good precedent to look at. Jim, you want to talk about hoops versus commissioner?
Yeah, even though we're in football season, basketball season is around the corner here. This was actually a case of with the NBA team, the Memphis Grizzlies, interesting one. And just again, we're going to move this quickly, but basically it's not unusual for a sale of a business to do an asset sale with it. In some cases, there's some assumed liabilities. Well, in this case, one of the assumed liabilities was some of the non-qualified deferred comp for some of the player contracts. And in this case, the issue dealt with when that non-qualified deferred comp, when is that deductible? And the taxpayer deducted that when they sold the the team and that a liability was assumed under the all events test. Next slide with the IRS, however, said, no, you got to look under 404, which is a different code section saying you got to pay it out when they pick it up in income. So it's a question whether 404 or 461 govern, and the tax court said that 404 governed. The IRS was prevailed in this case. And then recently, just last month here in August, the 7th Circuit also sided with the IRS saying, yes, we think that the 404 governs. So anyway, it's unsure if they'll appeal that to Supreme Court, but again, it's not unusual to have these assumed liabilities in asset deals. So keep an eye on this hoops case here. And then the last one here is just R&D credit. Again, there's a number of cases each year with R&D. The IRS seems to have been fairly successful with some of these cases in recent years. This is one that came out earlier this year and it hasn't been released yet, or the decision with it. It's with GoDaddy, the Worldwide Internet Domain Registrar. But they had $175 million of qualified research expenditures for the credit back several years ago, a large credit. Again, we'll see what happens with that, but it's just an example of a number of the cases that come up with R&D. Next slide with just some reminders with R&D, documentation. So important to get that with R&D. The IRS, again, has been successful in some of these cases. You somewhat feel emboldened here, so make sure you get like an R&D credit study. Adjustments are still possible even with the study, but without a study, I think you're going to be in trouble. And just be aware that starting next year, I think actually for 24, there's going to be an expanded version, additional information that you're going to have with the R&D form 6765. So here's your next code, 864.
Here's the next code here, and we're going to hit. We'll give it just a second if you want to scan that real quick, and then we'll hit to our last area, which is our. I'll let Jim introduce the lightning round. So Jim.
Yeah, so you got that 864. Okay, put that in the chat there for him there, Tom. Okay, here's what we got. Is we thought something new we'd try, with this with our webinars here. It's kind of like some of the game shows or sports talk shows you get. We're going to get several unrelated tax topics that we'll cover briefly and then move on to the next topic. Again, less than a minute with each one. We're going to go back and forth between Tom and myself here. So let's get started here. Our first topic, Tom, go ahead, get started.
Yeah, so, this is a concept that, I'm surprised how many people maybe aren't familiar with, but as a lot of what's happening in Congress is they're trying to incentivize folks to save money for retirement. Cash balance plan is a hybrid plan. It's a great plan, really a way for owners to supersize their retirement plan contributions. You can really assess whether or not this is a fit for you. And really not spend much in the way of fees and see if this fits. But it's really, really a great product. So, if you want more information about the cash balance plans, let us know. But just want to encourage folks that it might be a great product, works well with professional service firms. So take a look at that. Jim?
Okay. Thanks, Tom. Next one, a charitable contribution documentation. Again, I think it's critical for you when you get this. IRS is looking at this more and more and just saying, yes, you made a donation, but you didn't have the qualified written acknowledgement. Okay, make sure you get those in all cases where it's required to get that. If you've got a property that you've given Form 8283 is needed, I'd be very careful. The IRS is really looking at these qualified easements. If you have that, be very careful with the documentation you have with that. Again, in many cases, the IRS is looking at these, and if you haven't crossed all your T's and dotted your I's, you're going to get these deductions thrown out with it. So be mindful of that. We'll ring the bell here.
So some proposed regs out there finally on cryptocurrency digital asset reporting, effective January 1 of 25. Okay, so not immediately. But they've defined brokers. There's at some point they'll introduce a new 1099 form. But basically, they're trying to define who's got reporting requirements and what has to be reported. And there's some staggering dates in terms of information reporting. But they're really trying to get folks, force some of these what they define as brokers to report these transactions because they think there's a lot of underreported taxable income here. So Also talked about real estate reporting professionals. Apparently, Bitcoin, maybe digital currency is used a lot to, buy those assets. And so those folks too are going to have some reporting requirements. So.
Hey, Mr. Belder, Tom. Okay, next one here. Our life insurance. This was actually from the Tax Cuts and Jobs Act. That a revenue ruling came out 2020-05. But it's really retroactive in effect in that it looks back actually to 2009. And basically what the IRS is looking at is if you have a life insurance policy with it, the basis in that policy is the premiums you paid. You don't make any adjustment for the mortality costs and mortality charges with that policy. And in the past, that's what the IRS had mentioned. So this could apply to both the whole life or term policies. I encourage you to look at this 2020-05, which again really reverses back the 2009 revenue ruling. And again, any transactions that you have with life insurance policies, whether it's individually or with a business where you're selling that policy or transferring it, you may have a gain or loss to recognize. Look at this ruling to see what your basis is, and you may not have a gain, or you might have perhaps a much lower gain or even a loss perhaps with it on it. So take a look at this revenue ruling.
All right, pass-through entity taxes. Most states have them now. If you're still filing a Schedule C, a Schedule F, Schedule E, and you could potentially convert to a pass-through entity, maybe an S corporation, LLC, a partnership. Remember that the entity can now get that state tax deduction. So. Might be worth looking at that. Of course, you're going to create another tax filing entity, which is an administrative burden, and there's a cost there for sure. So you have to take a look at that. But that workaround can be pretty valuable if you've got taxable income coming through that entity. So, Jim, there you go. You got the bell.
Good. Okay, almost done here. Corporate Transparency Act. This was actually some new reports that was enacted a couple years ago that's going to start actually next year, but it was designed to combat, tax fraud, terrorism, money laundering. FinCEN will be the group that administers it. Again, the same one that does your FBAR filings. Requires certain corporations, LLCs, and businesses. And what they're looking at is the beneficial ownership information, or BOI. And they're looking at not only who the beneficial owners are of that business, but who are the individuals who filed the application with the government one. They're referred to as the company applicants. Now, one thing the FinCEN just issued a guide on this, some information. It's actually in your chat. And there's 23 exemptions that you don't have to worry about filing this. One of the exemptions applies to larger companies. If it's a large operating company, you don't have to file it. And again, more than 20 employees and over 5 million of receipts. That's part of the two of the 6 tests that are included in there. So if you're a larger company, you may be exempt from some of this new BOI reporting, but it's unfortunate those that are smaller than that are going to have to deal with this. And I'll pass that back over to Tom. We'll get part 2 of this.
So just out today, so this is effective next year. So if you have an existing entity that isn't exempt under one of those 23 exemptions Jim mentioned, you've got a year. You've got a year to figure this out. If you create a new entity next year that falls under the Corporate Transparency Act, you now have 90 days, not 30. It was 30. You have 90 days to get it filed, right? So that's like today. Now, if it changes, right? If you change beneficial ownership, change any material change you've got, you still have to file within 30 days of the change. So, frankly, one of the things that I think the business world is trying to figure out is who's going to take ownership of filing these. The IRS actually estimates there's going to be almost 33 million of these filed next year. Okay, this is a brand new form. And as Jim said, the one thing I think you got to remember is it's your standard vanilla operating entity probably is exempt under one of the exemptions. It's all these small entities that are created, sort of blocker entities, or pass-through LLCs that own interest in another investment. Those are the ones that are probably going to end up you know, having to file. So pay attention to this. There's a guide in the materials. So Jim, I'll turn it back over to you.
Okay, good. Our last one here is last shall be first here, a LIFO inventory. Again, just something to be aware of. Again, it's an inventory method that's still available. What it matches up is your current cost with your current income. And again, as a lot of companies have encountered inflation over the last number of years, the higher the inflation you have, the more beneficial LIFO is, because it's those higher costs are treated as being sold, which will reduce your income. So again, LIFO is used to reduce your, you know, your taxable income. And again, it can provide some savings for you. Again, it looks at the cost flow assumption, not the actual physical flow of the goods. One thing to keep in mind if you look at LIFO though, is you have to use it for your books. So it's not just for tax, your books have to be on LIFO too. That's a requirement. And then one thing we look at with LIFO is there's a government method called the IPIC method that allows using government prices to determine your inflation, which again could provide some further savings. So important to look at LIFO if you've got a manufacturer distributor with the rising prices. Take a look at that and see if it might be beneficial for you.
All right, and with that, I want to thank everybody for joining us. Thank you, Jim. That's well done. Just a reminder to complete the survey that pops up after the webinar to receive CPE credit. Check out through with the conferences.io, and certificates will likely come much quicker through this new system, which is one of the benefits of it. So you should see those within a few days. If we had any unanswered questions, or if you put any questions in the survey, we'll try to get back to you with those answers in the next few days. And thank you very much, and have a great day.
Okay, thanks everyone. Bye-bye.